Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of March 2nd, 2025. And in this week's episode, we are going full anti-Sprocket trading style, and we are going to talk about buying options. And is buying options really an option? Viper decides that he wanted to get back into the world of options by basically trading the anti-Sprocket, and he bought some options in Walmart. And so we are going to take a look at how that panned out for Viper and talk through the mechanics of what exactly is an option again, as a reminder, and why does it provide so much leverage to your trading game. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. I also think that Viper might have a page up there too now, if you /viperxl007. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. Viper option trading. I don't know what I said or how I said it, but you decided that you were going to go take a stab at options, and you're like, hey, this guy talks about option selling all the time. I'm going to go buy an option. Talk me through what led you up to buying an option, and talk me through that, and then we'll break down some of the option and stuff around it.
Yeah, I mean, really, what I'm pulling for is the day that I buy what you're selling. But actually, I hope if everything goes well, that day will never come, because if I'm buying what you're selling, either you're selling way too cheap or I'm buying way too high. So that's the litmus test. If I'm ever buying what you're selling, one of us needs to stop what we're doing.
Well, yeah, I don't know. We've done lots of episodes where we both can be winners with the same strategy. So maybe it will be a true confluence of things if we end up you buy what I sell and we both win.
Yeah, for sure. Maybe. I mean, we'll certainly call it out if it ever happens. And like you said, because I am officially on the beat in options world, definitely thetagang.com/viperxl007 is a thing now, because all the cool kids were doing it, and I do like. So okay, so let's go through how that got there. First of all, because this is a brand new strategy, like it's kind of I was at a point where, like I've mentioned multiple times, needing a reset of strategy, focus, something, this, that, or the other. And I'm not saying this is it, but this is just part of like an exploration here. So I did really like the opportunity to start a fresh tracking thing, obviously with Theta Gang, is interesting. And so it's always been on my mind as far as the power of buying options, and it, certainly, taking cues from you on the options world, very much understanding your strategy, the cracking the singles and all that sort of stuff. And like I mentioned before, when I've tried it, it just never really clicked for me. So coming around, and one thing I've struggled with for years, I mean, to this day, in many ways, still struggle with, is the screening process. And I mean, I guess, depending on the topic of the week, we always call out what the hardest thing in trading is, so that's a little bit of a dig at us that what I'm about to say might change next week to whatever next week's topic is. But to me, today, the hardest thing in trading is your screening process. And that's just because, I mean, there's so many ways to screen for plays, and part of that process. I mean, obviously you've gone over your screening setup very thoroughly. I think it is very well tuned, and it is tuned very explicitly to your strategy, which is perfect. Um, but for me, like swing trading and things like that, it's hard to know what to screen on. And when I was swing trading equities back years ago, I forget the name of the website now. It'll randomly come to me, but there was a website that would kind of screen based on different key technical data, and so I would kind of go through that and be like, well, you show me the charts that are doing this particular setup, and just trying to surface what I'll call high value targets to the top of the heap. And what I ended up finding myself doing a lot was just kind of dart against the wall of like, well, I don't know. People are talking about this ticker. Let's go see what its chart looks like. Let's go see what this. And so it was just this meandering, frustrating waste of time to screen for plays. And honestly, that's one of the reasons that it's been hard to get back into equities, because, in crypto land, I have a better, finger on the pulse of what is happening in the market. There's not hundreds. I mean, technically there are hundreds and hundreds of tokens, tickers, whatever you want to call them. But there's only a handful that actually have high liquidity, that can move and get accurate price fills and all that kind of stuff. So it's a much smaller pool, which means I can just much more quickly, rapidly be like, oh, this thing's moving. I'm going to go look for trades here, there. So the screening process was a problem. So I had been trying to build, still kind of am building, but sparing the details, an AI agent, which I'm trying to build to be specifically a screener, essentially, where I want to build this thing that's constantly monitoring the options chains as well as equities charts, and it's looking for certain patterns or certain setups, and then it calls out potential setup here, and again, not because it's the golden word of like, go take this trade, but it's just surfacing those high value targets. So that's been on my mind for a month or so, as to building that AI agent out. Serendipitously, I happened to find this website that literally is doing exactly what I wanted to build, which is utilizing AI or large language model, LLM. And then this website is specifically options focused, and it's surfacing high value options plays. And so that's kind of where it started. I dug in there, and I was like, you know what? There was a little bit of confirmation bias of, hey, I wanted to build this exact thing, and this is the exact thing, and it's working and it's here. So I just want to go in and see what's happening. So that was essentially where it started. Was the first swing that I took were 4 different plays, 4 different buying options, and they were all targets that were called out by this website. And this is not meant to be advocation of this website or this strategy right now. This was just me, everything we've talked about on this show of, here's an idea, here's the mechanics of it. I understand the mechanics of it, and we'll get into the risk mitigation and all that kind of stuff. But at the end of the day, I understand enough, but I need to touch it. I need to get in it and then refine my strategy from there. And so that is where we are today, is the result of that first touch and figuring out what's working, what's not, what needs to be tweaked, and all that good stuff.
Yeah, Viper, that sounds super exciting. Actually, before we get into some of the plays that you had set up, what I'd like to do is just do a quick refresher on what's the anatomy of an option, because this is going to be important, I think, as we talk through your plays and what actually happened. And so what I want to focus on is what determines the price of an option, because you're buying it, I'm selling it, right? But how do you determine what that price is? What's that price composition? And what happens to that price as things go, because it's very dynamic, right? It's dynamic in the sense that it changes when people trade it, but it also would change if nothing happened, because there's time decay and stuff like that associated with it. So I have up here on the screen kind of the option price is always broken into 2 halves. And the price that you see for the option is the concatenation or aggregation of these two halves. So The one half is called the intrinsic value, and the other half is called the extrinsic value. And if you add those two things together, boom, there's your option price. And you might think, well, what the heck? What's intrinsic? What's extrinsic? How do I know what that is? And the way that I would describe that, the way that I describe it to people is start with intrinsic, because it has the word in it. And so intrinsic value is the value that is in the option inherently, like built in, can't be taken out, exists there no matter the time left or the volatility or anything. It's basically it's intrinsically there. And that is simply the difference between the strike price and the underlying price. So for example, if you were selling a put at $100 and the stock was trading at $95, you are $5 in the money. Therefore, there would be $5 of intrinsic value in that option. Now, it's not the total price. You have to add on the extrinsic value. And so extrinsic value is basically everything else. And you'll hear this referred to as the premium. It is the price above and beyond the intrinsic value. And this is largely, it's made up of many, many components, but for the sake of this episode and for all practical purposes, you can think of this as time and volatility. The more time, the more price. The more volatility, the more price. And so as time and volatility come down, the amount of extrinsic value gets smaller and smaller and smaller. And so the price composition becomes more and more weighted to the intrinsic value. Now, what I did here is I also threw on a chart here to the side. And that chart is an option chain. And this is for Walmart. So Walmart, at the time that I took this snapshot, was trading at $96.20. And you'll see kind of a blue shaded area and a black shaded area. The black shaded area is what's known as out of the money. Okay. This means that the strike price is away from the underlying price. And if you look over at the definition, the difference between the strike and the current price is your intrinsic value. If you are out of the money, you have no amount of intrinsic value. Your intrinsic value is absolutely pure zero. And so you see that first strike of $95 is outside of the money of $96.20 because this is on the put, so it's on the downside. And so that's why you see all of these things here in this column have 000 intrinsic value. Now, the bid and the ask, this is the price of the option. Okay, that is the aggregation of both intrinsic and extrinsic. And so you can see right here at $80, the bid and the ask is 17 and 19. The extrinsic is 18 because that's the mid price of the bid and the ask, and there's no intrinsic value. Now, as soon as you start getting into the money, which basically means strikes above 96.20 on the put side, you'll notice this is getting higher and higher and higher really fast. Well, it's getting higher and higher and higher because that's the difference between 126 and 96.20 is 28.76. That's why there is $28.76 of intrinsic value. This is all important because when Viper talks about the price that he paid for the option, we have to know, was that option in the money? Was it out of the money? How much time was left and how much volatility was left? Because those are the factors that all go into this price composition. So I'll kind of leave this up, Viper. Let's talk about maybe your Walmart trade first on when you might have purchased it, and if you can remember any of the details around that.
Yeah. So let's just jump straight in to the chart here because I'm also trying out. You have your Flappy Bird charts. I don't have a cool name for mine yet, but I am trying to journal chart. What's happening when I do it. So I've rewound the chart here to about where I entered. And so one thing that I think is super important to visualize, especially so the current strategy that I'm employing is generally short time to expiration. And so therefore short time, just like Sprocket was just saying, short time means I'm playing for volatility and trying to capture that. Not saying that's the right way to go. That's just where I'm currently at. So when in a I don't even want to say short time, in any time frame. I think it's really important on the chart here that I chart the expiration, and I'm also charting where I entered at. And then just to make it easier to see, I put this yellow line about where the price was when I got in. It's a little off the screen there, but that's like around $98 on the underlying, something like that. And then I also chart my strike price, because again, that's the goal, that if we get to expiration and price is above the strike, that little paper coupon I got is nothing but paper and not even worth the paper it's written on, because it's digital. So this is what we saw when I got in. A couple things is my screener called it out of, hey, potential opportunity on Walmart. And like I said, I'm still learning the screener, still learning how to use it. So step one was, all right, I'm just going to jump in, and let's figure out the validity of the call and all that sort of stuff. But because I was jumping in, risk mitigation, position sizing, you'll see that I bought 2 puts. And there is a little bit of that I want to circle back to eventually, but bought 2 puts there, bought them for 76 cents. So it was $76 per put, which brought my total in on Walmart to around $140. And that is, when you're buying options, that is money spent. That is potentially money gone. If we get to expiration and prices above strike and I still hold that is $140 vaporized. So the reason I got in, obviously the screener called it out, and then I was like, well, let's take a quick look at the chart just to see what's going on the chart. I mean, Walmart, you can zoom out if you want later, but it's an up only chart right now. So what I saw though was it's top heavy right now and due for a retrace to, potentially $94 to $96, somewhere in that range. And so if I zoom in, when I got in, and this is something that Sprocket could probably unpack a little bit here, because it's usually his bread and butter that he's always talking about. I thought I got in too late, because, yes, it's due for a pullback here, but after hours, we can see that pullback already started. And spoiler alert, there's a little green ticker down here that I completely was not paying attention to, which is important in just a minute. But I got in after this pullback. So everything we just said, time, volatility, I thought that I was making a bad purchase, hence position sizing, potentially because there was volatility already baked into this. However, I was like, you know what? We're for science. I've made plenty of much larger donations in the name of science and education that I was willing to chalk this one up for the experience. So that's where everything was at when I set up the play. And I guess I'll just run through real quick. We'll fast forward to real time on the chart and see what the heck happened after I did that. And looky, things went immediately in my favor. And so it did cross my mind when I entered that, sure, we had this big move down, but we bounced. And so some of that was also in my mind of, all right, strike is well below us. So we did the volatile move and then more volatility as we bounced up. So let me jump in and, on the read that we're still going to go back down. And back down we did. It took all of 2 days before, 1.5 days. It was after hours, or no, it was the next day. Strike was breached, and we officially switched over into that intrinsic value of the strike being breached, the value being derived based on what the options represented. And then not only was it breached, but then the next day we pushed even deeper, and we pushed down to like almost, low $92 here before we came springing back up. So this thing went red hot in profit. I think at peak down here around 92, I want to say it was around 550% profit to 600% profit. And then as it stands right now, as of recording, I am down 60%. So there's a lot to unpack in all of that. But for now, that's kind of how the play set up and where it stands currently. So, Sprocket, what are your thoughts on, was I too late? And what is the deal with this little green E down here? And how did that potentially work in my favor or against me?
Yeah. So the first thing, that green E means earnings. So that huge move that you saw was an earnings move. Walmart had reported before the bell that particular day, and they missed, and just kind of the market barfed. And that's important because leading up to a binary event like earnings is a very, very big uncertain thing. And so volatility in the option chain will pump and pump and pump. And immediately after earnings is out and done, as soon as the market opens, all that volatility just evaporates. It deflates. So let's say your particular strike that you picked up at, I'm going to say $70. I don't remember the exact number, but let's say it was 70 cents, right? That same strike, if you'd have tried to buy it the day before, now let's assume that the price was the same because your price was closer to the money, but let's just assume that it was the same price. Probably would have been 2 to 3 times that cost before earnings, because there's all that extra volatility. So, depending on what your strategy is, that could be good and it could be bad. The reason that it's good is because when you bought the option, likely a lot of that volatility would have been already taken out. So the price you paid was less. Now, the drawback to that is, well, the volatility is out. So the move is largely kind of happened. And you see that visually there, right? When you got in, the bigger part of the move was already done. So that's a trade-off that you have. Now, when should you have gotten out of the option? And this is where knowing what the intrinsic and extrinsic value actually is can really come to play into your strategy. So you spent 70 cents on those options. And at your peak there, you were basically, what you said, 92. It was a $95 strike, if I recall. So you're talking $3 in the money. So right there, all things taken out, right? You are $3 in the money, which means those option price was at a minimum of $3 plus whatever, premium was in it. So that's where you have to start thinking, okay, look, what's the likelihood that this is going to go deeper versus if it starts to retrace, that value is going to evaporate as price moves, which is what you saw. As soon as you kind of started coming back to your strike, all that intrinsic value disappears because it starts going away. And the price drops so much because you're close to expiration and the volatility has come out. So you didn't have a lot of intrinsic value to fall back on. And so that's one of the risks as you approach to expiration so close, is you don't have any extrinsic value as cushion. And so when you're deep in the money like that, you're kind of gambling, and you're almost betting that in order for you to make more money, you got to go deeper, because your option isn't going to pick up more volatility. It isn't going to pick up more time premium at a rate that's going to outstrip the decay. So those are a couple things that I kind of wanted to call out there, is that your optimum exit point probably honestly should have been the strike. Now, if you were pretty confident that you were going to punch below the strike, sure, hang on to it a little bit more. But when you got to at the money, you still would have had decent volatility in there and decent time premium that you probably could have closed out for maybe double profit would be my guess. Maybe 80% profit, something like that. But then as soon as you start dipping into the money with almost no time left, that's where you're really treading on thin ice, because you could quickly give back everything in an instant because it'll move so quick, because there's not much time left and there's no volatility really left.
Yeah, and I would say that tracks with my experience. So there were some key takeaways here. Again, like I said, this was not meant to be the perfect play. This was dipping my toes in the water. Let's make some mistakes. Let's figure it out. Let's iron out that strategy, which is a point that I'm going to harp on a lot because I think it's important. I think it's important to understand as much as you can before going in. We always talk about that. Then it's important to, when you go in, don't whole hog this thing. Like, dip your toes in, position size, because you're going to mess up. So when something messes up, when something blows up, make sure it doesn't blow the house down. And so my takeaway on this specific trade was kind of exactly what you said. It was that, and I'm not going to hindsight this and say, oh, I should have just sold the bottom. It's that easy, right? You just like, no, that's BS. Because who knows? And so it did cross my mind when we broke strike on this day that I was like, this feels like when I should get out of this thing. But again, there were two things that happened. One was the emotions of, whoa, it worked. Like one day later, and I'm staring at this, 550% profit. Like, this is awesome. And so there's that emotional distraction where if I zoom out again, there was, and so part of this was a lack of journaling. There was no journaling. There was no writing down my thesis. There was, looks good. Let's go in and see what happens. So journaling would have reminded me that this was it. This was the move I was expecting, was 94 to 96, as I said from where I charted it. I don't know how much more you can get to that range than literally hitting on that day 94.50. And so not only hitting that price, but hitting it with volatility. This was a 3-hour period on open where we just dumped from 97 all the way down to 94.50. So that was the gift. That was the play. That was the closeout. If I really wanted to be cute with it and be like, what if it keeps going? Like, give it a couple hours after, right here, when it clearly stopped and started resting. Because when it started resting, now all the other factors are playing in, and that whatever extrinsic value is still in there is now bleeding because we stopped the volatility. So, so my hindsight was the inkling that I had was something I should have leaned into, and I should have had written down that this is the play. Don't be stupid and keep looking for more once you get what you were looking for. And that is certainly a trap that you can easily fall into, is if you're not focused on the thesis, you get what you came for, and then you're like, but what about more? And you change the game. So that was absolutely the exit point in my hindsight. And then to your point of what happened since then, we went deeper in the money. Sure. I mean, but this was greedy here. No one, a double day dip. And then to your point, as it started retracing, I mean, this thing just, evaporation sounds too slow to what happened to this thing. Once we came back to strike,
vaporize is the right word.
And then as we went higher here, I mean, it was toast. It was at the peak up here. So on it, when you buy an option, when you're looking at it in your brokerage, you can see virtually, I don't know that it's infinite, but you can see a ridiculous amount of profit percentages show up. You can only ever see 100% on the loss side. Because 100% means whatever you paid is completely gone, and it is now a worthless option. And this thing on this bounce back up, these Walmart shares or contracts, they got down to 90 or 85 to 90% value lost. And so at that point, I was like, all right, I mean, this was an experiment. I still have a little bit of time to expiration. The PA, the price action here was like, okay, maybe we get some resistance back here in this range, which did seem to happen. I'm going to close these things out on whatever the move is in the morning. and I might salvage a few bucks. But I'm definitely not. I mean, unless I get super lucky, and tomorrow we dump below strike, that would be best case scenario. But it was a good lesson, and it was a risk mitigated, position sized properly lesson, and I think I took away what I needed to take away out of it, and it was good. It also helped. On the flip side, I had a bit of a better play on hand.
Yeah. Before you hop to your other play, one of the feedbacks that I'd kind of give when you're trading this thing is, we always talk about your exit plan. Honestly, I think very similar to how I go into selling options, and I say I'm okay with assignment. I'm taking assignment. Type of attitude. I think when you're going into something with so close to expiration, you should really say my exit point is expiration. If it's either your profit target or expiration, because some crazy things can happen to the options on those last few days, which is why I always try to close out before we get to some of that if I'm hit my profit targets. Because what you did here, it's fine to do it, but you basically locked in your 85% loss or whatever it was, 75% loss. So you could have left your 15% of the money on the table as just maybe something crazy will happen and we'll go below the strike. Because as soon as you go below that strike, you're going to inflate very fast on your intrinsic value. Because you're effectively controlling 100 shares. And that's really where I think the power of options, and we'll touch on this, I think, on your next trade. But you have to remember, you spent $70 to get the return and control of 100 shares of a $95 stock, right? So you spent $70 to control $9,500 of potential notional value. And so that's really where those big gains can kind of come from. Yeah, the drawback is you could lose everything you put in. But if you do that position sizing, my recommendation, Viper, next time around with so close to expiration is don't bother bailing. You're not saving much face.
Yeah, no, that makes sense. And actually, that's a really good point, because I wanted to touch on briefly why I kind of immediately became attracted to options buying specifically. And that was exactly what you were just touching on, where this value, this notion of extreme leverage. I mean, and by all accounts, that is extreme leverage. I mean, doing the math real quick, 9,570, that is 135x leverage. That $70, like you said, has the potential to control $9,500 worth of stock. So real quick, like I said, the other reason that I just let this Walmart thing ride was because I happened to have already made and locked profit on another potential trade that I had at the same time. So hopping over there real quick, we'll slide this out of the way. And this is some puts that I bought on AMD. And this one, I took the price was a lot cheaper. It wasn't the $76 of Walmart. But this one, as I charted it, I was like, oh no, like the chart on this just makes sense for this entry. So, you can see here where I bought in, where expiration was. Again, this was still the week out sort of thing, but I wanted to zoom out just to see the chart here. And this thing from a chart TA perspective, few times do you come across something as clean as this. I mean, this is just stair step, stair step, stair step, stair step. And so we were, at the time that I was looking at this chart, at the time the screener called it out, I looked at the chart and I was like, holy smokes. Absolutely, we have no idea where the step down is going to happen. It could happen anytime. It could happen slowly, fast, whatever. But it was just perfectly set up where we were already climbed up to the failure level where it would trigger the next step down. So this one, I was much more confident in the TA of the chart here, and this play is where I really started to refine my strategy of like, okay, the Walmart trade, yeah, the chart showed a little bit of a retrace, but that was more of a scalp against the trend retrace. This one here was much more of a no, this just looks fundamentally, we're in a downtrend. We've climbed and we're about to go put in a new lower low. And so just this was a trade that just everything came together of like, nope, this is a good one to be in. Lots of technical confluence and whatnot. And as you can see here, boy, did it work out. This one, and so again, no little green E down here. So there were no earnings on the books. There was nothing. The earnings had already happened a week earlier. So there was nothing, juicing up those the premiums on those. It was just a simple, nothing super volatile as we climbed up here. And then after I got in, we started falling down, and gravity pulls a lot harder than you climb against it, apparently. And so volatility starts just stacking in here. Every day there was a big drop, and the volatility was climbing. And on this particular one, fresh off of the lesson learned and the opportunity missed on Walmart, let me make this line just a little bit thicker so we can see it and stand out in. Nope, green's already used. Yellow. This, as we approached strike, we kissed the strike. We came off it a little bit, and then we started coming back down again. This is where I closed out. I was like, you know what? Again, those lessons learned started to kick in of like, look, volatility, and we're at strike. I mean, so I closed these things out at like 750% profit. And I mean, granted, hindsight and all those things, we're now in the money, going into the day of expiration, day after this recording. But honestly, I don't really have any regrets. I mean, if I regretted anything, it was, leave a couple runners. Like if I have 8 puts in this case, leave a couple of them just to see what happens. Because again, going back to that point of paying a small amount of money to control a very substantial amount of money, on this play, if I was going to dissect anything, it would be, okay, if I bought 8, leave 2 of them hanging out there all the way to expiration, and let's just see what happens. I think that's very valid. But ultimately, this was just a good, like, this paid for the education. This is the other 4 trades taken total. This one covered everything and got me in profit. That's a great place to do some learning.
Yeah, one thing that I want to kind of give you some feedback here on this play, you mentioned that volatility was building and building and building, which is probably true. Volatility probably was increasing in there. However, there's not much time left in the option. And so the amount that volatility, when you're really close to expiration, that volatility will only really kind of influence the closer to at the money strike that you actually are. And so where you sold is perfectly the optimum time to do it. Because you look at where it goes after where you said it, you sold it. It didn't go anywhere really. And because you're so close to expiration, that premium is going to evaporate super fast. And what I would kind of, you didn't have earnings here, but in the Walmart earnings, I have had many an earnings play where I'll collect, like $300 on the strike, right? That's like a 20 delta. I get the move and I'm only 5 cents out of the money or 15 cents out of the money, and I'm still super green because that much stuff evaporates close to expiration. And so, once you're that close, you're really just playing the move of the price. You're just really playing for in the money. And so as soon as you got to at the money, I think that's the perfect time to exit out of that with such a big gain, because you bought it so far out of the money. Just that simple coming there close to the money would have baked up a bunch of costs there.
Yeah. That makes sense, and that's certainly, part of the thought process in my head is yeah, exactly kind of what you were just laying out. Where as we get closer to the strike, to being at the money, this is part of what I want to try to keep better track of in the data. But it's that trade off of, okay, what is the intrinsic versus extrinsic value, and then once we start pushing into the money and start to go flat on the volatility, there's a lot of money that, I don't free money, the extrinsic money, that's just going to bleed off. And so, let's just say that this thing expires at, let's say, $1.04.90. So it's like 10 cents into the money and it expires there. Hooray, I got expiration. I got value assignment. But that wouldn't necessarily equate to, or potentially that might not equal the value of the extrinsic on this particular move. So that's some of what I want to keep track of and keep in mind as well, on future plays.
Yeah. Now, the one thing I did like about this trade that you did take, and I really think you need to incorporate this into your screener, is where are you at? So when I play, right, I'm looking for extra extended volatility. When you're buying options, I think you should be looking for, depressed volatility. So when you entered this one, you said, "Oh yeah, earnings were a week earlier or a few days earlier," right? You already had a big drop, you already had a deflation, you already sucked that volatility out, which means you're not kind of paying extra for that premium. And so I think if you have a screener that is pointing you to good price action levels, and you combine that with a lower volatility, and then you figure out what the appropriate time to expiration is, that you like to do, that's where I think you get your extra edge in this strategy. So I don't think you should blindly, just like I don't blindly go grab any old option and sell it. I only look at things that have extra extended volatility. So I think if you're looking for swing trades or pattern trades or resistance or things like that, you should then further refine it to, if you want to trade with this extra leverage, get one that has abnormally low volatility, because remember, volatility is kind of an oscillating thing. And so there is a reversion to the mean. And so if you start buying something that is, kind of extra lower, you have a probability that it's going to increase in volatility and maybe make the move that you need it to.
So, but the question on IV then for this strategy, so I know like your strategy, you're looking for like an IV of what, like over 80, something, 60, 70, 80, somewhere in that range?
Yeah, so Viper, it's not really so much about any particular number of volatility per se, but it's a historical volatility. Where do you fall in the rank of the implied volatility? So I typically will chart the implied volatility of the stock over the past, year, and then I'm looking for something that is in the upper half of that range of oscillation. And so it shouldn't say a range of oscillation. Your volatility numbers, I want it to be above 50 to 60% of where it's been in the past. So if your range is, between 20 and 100, then maybe I'm going to look for a spot volatility in that 70 to 80 range, right? But if your volatility goes from, 90 to 700, I might be looking for a spot volatility in the 500 range or something like that. So it is relative to itself as far as volatility goes. And so when I'm selling, I'm basically looking for anything above 50% of its historical volatility, which means over the past year, it has been, lower than that value more than half of the time. And I think the flip side that you would be looking for is you'd be looking for whatever that range of volatility is over the past year. You would be looking for anything below a certain, not absolute number, but below the percentile of that range.
I see. So that makes a lot of sense. And actually tickles the brain on, just thinking out loud of kind of what I've been doing on charts and things like that is TradingView has an incredible community of builders that build all kinds of different neat indicators and things like that. So what you just said has the brain tickled in that would not surprise me, and I'm going to go looking for this, if somebody's built something that shows like a volatility oscillator or something that does the average and automatically charts it or something. So long story short is that's interesting. I'm going to go look for something to add to the confluence of data that makes it a little easier to surface. And if not, maybe I'll just build one where, like you said, take a chunk of time, grab the median, and filter out of are we above or below. So that is what brings me back into equities and into the options world for now. I have an inkling this could be a thing that'll last, but certainly follow along, Theta Gang, all that good stuff, and ultimately, what I do love about this is the ability to properly position size and risk mitigate. So, like I said, this is involving high leverage, high risk. So, I like the fact that I can use a very small portion of my portfolio and experiment with that. And certainly anybody looking to get into this, highly, highly, highly stress that aspect of it. Of yes, it's really easy to show up and just throw a whole bunch of money at it, and now you're like officially gambling and possibly to lose it all. But at this particular point, for me, what is really keeping this enjoyable to me is that position sizing, keeping these plays to 1 or 2%, just like I would on any other play, regardless of what leverage is at stake.
Yep. And that brings us to the end of this week's episode. And if I go back to kind of that baseball analogy that I always talked about when I sell options and it's single after single after single, I think your strategy is really around how can I pay for a bucket of balls and get the most amount of them out of it so I can take the biggest shots to see how many of them I might be able to hit out of the park. And so as long as you keep your price under control for what you pay for each pitch, you can really, swing for the fences. And I think that's a difference. And it can absolutely work out, right? I opt for the higher probability of wins, but my wins will be much, much smaller. Where your strategy that you're kind of looking at is if you really understand the mechanics of it and you only are putting quarters into the machine, right? You're not going to the slot machine and putting in your $1,000 a pull. If you're like, yep, I'm going to play the quarter slots, you get to take more shots. And if you target your shots for kind of the good pitches that are lined up to your price action, lined up to the other things, and it's not just randomly taking shots at option strategy and you hone it in, then I think you're creating a situation where you are taking swings at the better probability of hitting it out of the park, but you're also not spending a fortune on each one of those pitches. And I think that's super important to understand because that's where I think option buying can get a bad rap. You alluded to it during the episode where, some people see this amount of leverage and they're like, geez, I can make one trade and retire. I'm going to go ahead and put my 10 grand on this one option buying thing. Or, they're going straight to the high stakes slot machines and they're putting all their max bet on one pull. Where I think if you slow it down, you'll have more fun and more enjoyment, pulling that slot machine more and more and more. And that's really understanding the mechanics. And then once you took a swing and the ball's flying through the air, knowing what's happening to the price of the option as time goes by, as volatility goes by, is it increasing, is it decreasing, type of thing. You can strategize and you have your exit plan. And I think that's very important because that's what's going to lead to success. As we've said in this episode or this show many times before, there's really no magic that a trader, in my opinion, or your opinion, Viper, has as far as an edge over other traders, except that risk mitigation. So, the amount of wins or losses that somebody has might be comparable from person to person to person, but how do they manage their losses? How do they control their downside risk? And it's that person that has the better risk management that will almost always come out the winner in the end, overall, between those different strategies, even if they have the same number of wins to losses. So hopefully this has given you something to think about. If you made it to this point in the episode, this is one of the things we've talked about before. Option trading can be a winner no matter which side of the trade you're taking, which is what's so awesome in my opinion about it. So hopefully you're finding the type of thing that you want to trade, the type of thing that gets you excited and into the market. And good luck out there. And remember, think outside the block.